Yield maintenance is a prepayment penalty with a calculation methodology that takes a look at your interest rate that you originated the loan at. So let's say today interest rates at the treasury, like 10-year treasury or 5-year treasury, is 3.5%. And so that's your loans being originated when the treasuries are 3.5%. And then let's say you prepay at another time when rates are, let's keep it simple and say 3.5%. So yield maintenance basically obligates the borrower to pay all of the remaining interest due on the loan, net of changes in the rates. So if the rates are the same from when you prepay to originate, then it's basically like, hey, if you're going to prepay a year early, 2 years early, you're basically on the hook for paying that interest cost for the rest of the 2 years. So you're on the hook for that interest almost no matter what. And then what happens is if rates are higher at the time of prepayment, then it actually benefits you because the lender is more happy for you to prepay, and they're in a higher interest rate environment now. So if you prepay them early, they can take that money and make a new loan and make more money, right? So they're more happy. But let's say someone originates a loan at 6%, and then now we're in an environment where rates are 3%. That lender's going to be pissed if you pay them off, right? So yield maintenance protects. It's call protection. It protects lenders against that because the prepayment penalty is going to be high. The yield maintenance is going to be higher to account for the fact that we're now in a lower interest rate environment. And so it's some fancy, complicated calculation to make the lender whole. Now, defeasance takes this concept and bolts on another layer to it, which is you actually aren't just paying the lender a prepayment penalty. What you're doing is you're buying financial instruments that are going to pay out the same as if you were to have kept the loan in place. So the reason why defeasance is even worse than yield maintenance is because you have to go through the headache and added transaction costs associated with buying a financial instrument to be able to facilitate the ongoing payments to pay out the remaining obligation to your lender.